Hey traders, welcome to our Sunday live Q&A show. I'm Raghee Horner, and we're going to be talking about kind of things that we're going to be looking at this week. But for today's Q&A, I'm going to take a step back because one of the things that we're dealing with is the end of quarter and everything that goes along with the sort of finality of Q1 in the books and how traders are positioning themselves for the long term. We'll get to that. And then also some of the ways that we can measure volatility so we can have a better way not to try to predict what happens next, but respond to what we're seeing and position ourselves accordingly. And with that in mind, one of the things that I wanted to mention is two really important points. One is V bottoms. A lot of folks are asking, do we have a V bottom? And based on history, it's not likely that we're going to see a V bottom in the current environment because usually V bottoms are a product of sudden and sometimes unexpected, I guess that sort of goes hand in hand, volatility shifts because the Federal Reserve has changed monetary policy. Think of any time we've seen sudden cuts or a sudden pause in rate hikes. Two really good examples from recent memory are the shift from Q4 2018 to Q1 2019. And then again, of course, the pandemic response. So these V bottoms are usually a product of the Federal Reserve saying, whoops, we made a mistake, or we're going to start acting. And that's really the way in which V bottoms get put in. So it's really the Federal Reserve. This particular set of cuts was well projected. And probably the second question related to this V bottom conversation is whether or not the Federal Reserve is going to cut again this year. And that is absolutely a yes. So far, again, not predicting whether they will or won't, because that's where traders get into a lot of trouble. They get into the prediction game rather than the reaction game. We're counterpunchers. It's not my job to second guess the Federal Reserve. It's not my job to predict where we're going to end the year. My job is to look at what we know and how price action is responding to what we know. Right now, it looks like there is a pretty high likelihood, if you look at it cumulatively, to 76%, almost 77% likelihood of a rate cut in June, and it's fully discounted for July. So when we look at what we knew at the end of last week, we have one more trading session left for this quarter, Q1. As of what we knew last week, even with the sell-off on Friday, it is still on track for more rate cuts. You might say, Rag, are rate cuts themselves bullish? This is where I'll say no. The anticipation is more bullish. So buy the rumor, sell the news is still the way that we would look at rate cuts. When we're anticipating them, there is a certain buoyancy we'll see to the stock market. Think of Q1 of last year, a year ago. We were waiting on rate cuts for May of 2024, summer, and then ultimately fall, where we had the 50 basis point cut. Now, waiting for those, the anticipation of them was far more bullish than the rate cuts themselves. So until we get the cuts, there's a little bit more bullishness that I would see from expecting the cuts, not getting the cuts, right? So let's make sure we understand the timing there. The other thing that I was looking at aside from this the scenario for a V, which I'm not looking for, is the topic for today, which is looking at volatility. I'm going to show you VIX, Fed Fund futures, which is what we're looking at right now with those graphs, and bonds. So Fed Fund futures are absolutely showing that rate cuts are in the cards. Now, when I'm talking about bigger picture, let's define that. Because a lot of people will use terminology like long term, but what does that really mean? Can we get specific about that definition? Absolutely. Two things are really important. Anytime there's any analysis, whether you're watching it, reading it, watching the show, time frame and time horizon. Both of those have to be part of the explanation of whatever it is that I might be looking at or a question that we're looking at. If your time frame is, say, a weekly time frame, where every single candle represents 1 week of price action. This, for example, would be a weekly chart of the S&P futures. Every single candle here is 1 week. That typically for me is going to map to analysis and expectation for follow through and risk management on a time horizon, the life cycle of the trade, for a minimum really of 6 months to multiple years. Some of the position trades, and I like to call these position trades, some of these position trades that I put on in the Sector Secrets Mastery have been on for, gosh, coming up this year will be 22, 23, coming up on 3 years. Some of them are 1 year old, some of them are just a quarter old. Case in point, this year we've built a long position in Coke, in Altria, and these positions are about 3 months old, as opposed to positions that we've built in 2022 with things like XLK, right? So please know, I'm talking months to years, not next week, not next month. I'm talking about months to years. And that would be a position trade, not something I buy with a leap and scale out of 3 weeks later. That's really a swing trade. That would be something I bill on a daily time frame. So I'm not really talking about the dailies right now. I'm really talking about the weeklies. Now, if I step back to that weekly again and take a look at, say, the S&P, if you watched the video from Friday, it was the sanity check setups. What is sanity check? Maybe that resonates, maybe it doesn't, right? But what that is when everyone's talking about crashes and corrections and lower lows, I like to define where price action is right now. And you can see at the very bottom of this chart, I have this label. And this label shows how much by percentage, for example, the SPY has pulled back from its all-time high of 613.23. A 10% pullback, right? 10% from that all-time high would be roughly 552. 20% would be about 490. And this is where I'm going to say, and I tweeted this out not all that long ago, I cannot actually remember the last time with that longer term time horizon when we had a 10 or 20% pullback and I put money to work, right? Rather than sitting on the sideline and worrying about lower lows, I put money to work. I can't think of a single time where fast forward 12 to 18 months, a year to a year and a half later, I regretted it. I typically don't. In fact, if anything, I typically regret not at least shopping for things that meet that sanity check setup criteria and put at least some capital to work. So check out that video. I get into a lot of detail about how that sanity check setup, which is a mouthful to say clearly, actually works. So everything I'm talking about is bigger picture. So first thing I want to talk about with you all are bonds. Bonds like to front run. In other words, they like to respond to things looking forward. And it was really interesting that this is a daily time frame I'm looking at right now, by the way, the ZB futures. So we're looking at the June contract of the bond futures. You can look at TLT as well if you'd like. And if you and I are looking at this right now and we're thinking, what are bonds saying about rates? They're not talking about rates in March or even April. Typically, my experience has been bonds will project forward expectations a quarter from now. Now, that makes a lot of sense when you think about it, because bonds trade typically, if you're going to look at the not TLT, right? If you're looking at bond futures, they trade March, June, September, and December contracts, the quarterly contracts. So it's not surprising that this is a June contract. Where do we expect rates to be in June? A quarter point less than they are right now. So is it unusual that bonds are reflecting that expectation about 3 months from now? And you're going to find typically bonds will do that. They'll look out 3 months from where price action is. It's not responding to Friday, it's responding to 3 months from now, 90 days roughly from now. So bonds are actually showing, with this movement higher on this futures contract, movement higher on bonds is movement lower in yields. So it's an inverse to the direction of the actual TLT or ZB futures. All right, another thing is volatility. All right, now there's 2 ways we can look at volatility. The first way is looking at volatility from the standpoint of, say, a volatility tool. All right, so I'm going to pull up Fed Fund futures. And one of the things that is really interesting about the way in which we look at Fed Fund futures. So if we're looking at the 30-day Fed Fund futures, right, we can look at that as well. That's one way to look at Fed Fund futures for upcoming months. Another thing we can look at is the VIX, right? The CBOE VIX futures. Now, I'm not talking about VX futures. So if I look at the VIX index, it's that 30-day SPX options tool. So it's a 30-day barometer or fear, greed, whatever you want to call it, right? It's commonly called a fear barometer. rather than pulling up. So two ways to look at volatility. One is through a tool that I use called the daily and the hourly price movement ranges, which is a look at historical volatility. But rather than look at that today, and you can see that on most of my charts with the gold and the gray zones around price action, but let's take a look at a tool that's job is to measure volatility, just like Fed fund futures measure expectations for monetary policy shifts from the Federal Reserve. Let's take a look at the volatility index, or the VIX. I'm not going to pull up the VIX or the VXX. I'm going to pull up the VIX futures, and here's why. Because I can look specific to not just a continuous contract, but I can look at VX, right, for June, which is the current front month, right here. So this is the June contract. You can see it's shooting straight up. The first thing I want to point out is what we call high or low. So let's just look at VIX for this year. I'm going to squeeze in VIX, the June contract for 2025. Is this the highest the VIX has been? No. Is it the lowest the VIX has been? No. So one of the things I like to ask myself is, are we going anywhere new? Is this VIX truly higher than where it's already been willing to go? And the June contract, in fact, is not. We're actually in a very large but already established range. Now, you might say, okay, Rog, if there's a June contract, is there another contract? There is. There's a September contract. And what I want to do is go further out into the year and start to look at the ranges that are set for those contracts coming up. Just like I could look at June bond futures and September bond futures. If we want to know what traders and investors are thinking for later this year, rather than predicting, let's look at the way in which those future contracts of these futures for bonds, for Fed funds, whatever it may be, could even be for the S&P. Let's look at where they are. Are they going anywhere new? Is the fear in September that much greater than the fear in June? And you can see they're all in a range. So let's identify the range. What would be high? If we're going somewhere new, to get above 2214 would be quite high. Let's go back to that June contract. And all you need to do is pull up VX, the letter M, 2025 for the year 2025. And this is the June contract. You can see here the June high was 2235. The high for September is actually lower than June. It's 2214. That's our first cue. When things kind of went ballistic, further in the year was a little bit less, a higher high. Not significant, nothing to read into, but it is a lower high than what we see in June. So to see something new, to see something that's a sort of a new panic, something we didn't see, we'd have to trade above 2235. What's normal? Well, normal does seem to be, as you can see, when things were kind of quiet, normal does seem to be somewhere around 18, 19, really anything under about 20. So getting back under 20 would be great in terms of getting back to where the panic isn't quite so great. So this is what I mean about being able to measure things and having a much more less panic driven, less, oh my gosh, type of psychology. Remember, television, newsletters, the internet, they want you and I to be in a constant state of panic. So we what? So we tune in. So we read their newsletter. So we watch their videos. So we read that blog. That's their job. It's to basically day trade attention, right? They want our attention for that day. And so the next day, can they talk more calmly, or do they need to ratchet up the rhetoric of grabbing our attention the next day? You know how this goes. It's just a constant. It sort of reminds me, I'm going to totally date myself here, sort of reminds me of the Jerry Springer show, right? Every year the guest had to be crazier. Otherwise we think, I've seen this before. So I kind of look at it, the way we look at financial media entertainment as sort of the Jerry Springer show. What new crazy thing, in this case, scary thing, can we parade in front of viewers so they stay tuned? Take that for whatever you will. All right, so this is where we are in the VIX right now. Now, when we step back, and let's take a look at those S&P futures. A lot of folks are wondering, Rog, what happens next? So here's the punchline. Nobody knows what's happening next. Can you imagine? We're already predicting, there's already folks predicting where we're going to be at year end. Can you imagine if today, and so let's take the stock market out of it, rather than me giving you my Dow or S&P or NASDAQ prediction, right? Which is what they commonly do on television. Can you imagine if I were to sit here and tell you who's going to be in the playoffs for the NFL? That's about the same prediction, isn't it? you got playoffs starting in December, January. You have that ramp up in the end. Can you imagine if I'm telling you not only who's going to be in the playoffs, but the way the financial media thinks? I'm going to tell you the score of the Super Bowl. What adult is going to say, oh, right, Rob knows the score for the playoffs and maybe who's going to be in the Super Bowl? Oh, no, I even know the score for the Super Bowl. That's what they're doing on television. Use a similar analogy and you'll realize how ludicrous it is that anyone's going to talk about projections. We don't know. We have to react. We have to respond. And in all that, we manage risk, right? Risk, reacting, responding. That's the job. And that's a whole lot easier than predicting. Nobody has a crystal ball. Who is it? Ray Dalio said that, anyone with a crystal ball just ends up with a mouthful of glass. So once again, we go back to things that allow us to look at how response is right now and then react to it. All right, is the S&P in a downtrend? Using the tools, using the metrics that I use, no, the S&P is not in a downtrend. Is it bearish? Granted, absolutely. And I'll keep this bearish view of the continuous contract of the S&P 500, not the SPY, not the SPX. I'll look at the ES futures. And as long as we stay below around 57.50, right, as long as we're below that, this is kind of the bearish weak side of the S&P where sentiment is a little bit more pessimistic and there's a little bit more fear. Now, if we start coming back down in the VIX, we'll likely see a little bit more strength and support in the S&P. What would be a new fear? Where would we say, gosh, Rog, we're going somewhere new? Essentially, if we break 5,500 on the S&P. So you might say, Rog, as long as we're trading between 58, call it 36, and 5,500, this is pretty much the same narrative, the same price action we've already been in. Yes, that's the point. Nothing new. Remember, it's the Jerry Springer show out there. We need to make sure we're kind of putting the blinders on, just looking at price action, looking at those Fed fund futures, looking at bond yields, and understanding how to measure all this. All right. So let's say we now then want to take another step into, all right, Rog, if you're saying that, most of the time you would regret not looking at opportunities when we have 10 and 20% pullbacks in the broader averages or even the key sectors, where are you looking right now? Well, it's interesting to see that there are a number of sectors right now that have actually pretty much gotten out of March fairly strong. There are a number of obviously very weak sectors, but there are 4 that have managed to, it seems for now, it's still one more trading day in March, it seems to have ended positively. Oil and gas explorers, insurance, energy, and gold miners. Now, everyone knows what gold has been doing. It's been taking gold miners with it. But what I like to do also is I like to see what has been able to maintain or even climb higher since mid-March, because there is definitely a thought that around mid-March, if we start to see surges and inflows in certain sectors, that could be where money is moving in to take advantage maybe of a little bit more optimism in Q2. And you might say, Rod, why would anybody be optimistic in Q2? Don't we know about fill in the blank? It could be whatever, tariffs are probably number one. I get a lot of folks asking, Rod, what about the tariffs? And here's my litmus test for this. If you and I are talking about it, it's been discounted. Do you think anyone out there is waiting until April 2 to respond to tariffs, or has that been what's been going on for 6 weeks? Buy the rumor, sell the news is one way to look at this. So is sell the rumor, buy the news. How would that work? Well, we heard about tariffs. We heard about reciprocal tariffs. We've seen the back and forth on that for a month and an exhausting half, right? Now, as long as those tariffs and the expectations that we had aren't met with something that's more dramatic or quote unquote worse than what we've imagined could happen or what we've told is going to happen, oftentimes that triggers a relief rally. We expected something really awful and it was only semi-awful. Sell the rumor, buy the news. Same thing with buy the rumor, sell the news. Same psychology, just in the other direction. So unless the tariff scenario is so much worse than what traders were expecting, that's just not going to be a shock on April 2. In fact, if anything, we've been seeing a lot of the edges softened on that tariff narrative, on those conversations. And that's where I'm not trying to be Pollyanna about this. I'm not trying to say everything's fine. I'm just trying to say that panic has never helped grow anyone's account. Instead of panic, replace it with a plan. And the way you can put a plan together is if there are some charts and metrics that you can track, that I can track, that we can do this together and say, all right, we're really not going anywhere new. Volatility isn't anywhere higher than it's been. And yes, we see a lot of scary candles, but a big down candle across an already well-worn path isn't something new. It's just a lot more drama, right? We had a lot of drama on Friday going into the end of Q1, but is it really something that's punching down to lower lows or sort of peak fear, if you will, which is what we saw at the middle of March, specifically with the low that was put in on the 13th down at 55.09. That's the way I want to measure this. And if you want to kind of stay above the fray, rather than looking at a 1 hour or daily time frame, take a look at a weekly chart. Ask yourself, this is the pullback right here. Squeeze in a year. This is 2023. Right? Let's go look at 2023 Q1 to 2025 Q1, 2 years roughly. Take a look at the move here. When this sell-off happened in late 2023, when this sell-off happened in mid 2024, and yes, the current sell-off that we have right now, every single time that sell-off was never on good news. It was on panic-driven news. It was on, oh my gosh, this is the beginning of the end type news. A lot of hyperbole, a lot of drama. Why? Jerry Springer, right? No knock to Jerry. Don't know him. Jerry Springer, right? So I'm not saying that this is the exact same scenario, but if you look back over multiple years, find those 10 and 20% pullbacks, fast forward 12 to 18 months, you're going to find this is kind of the uncommon logic. These are stocks on sale. Everyone says they want to buy the dip, right? Until the dip happens, which is sort of the same thing that Mike Tyson said, right? Everyone has a plan before they're, until they get punched in the mouth. A lot of folks are getting punched in the mouth right now. What is the plan? What do you know from historical action is most likely what's going to happen next? Nobody knows the future, but I know this. I've grown accounts throughout my life, not by being a pessimist, not by talking about all these disaster scenarios, but rather by being an optimist and waiting for sales in things that I deem are valuable. Maybe what's valuable could be a dividend yielding stock. Maybe what's valuable could be staples. Maybe you're looking at utilities, something a little bit more defensive. Maybe you're looking at things you wish you could have bought at lower prices and you're saying, gosh, Apple's on sale. Do I think Apple's going out of business anytime soon? Would I rather be long Apple from 250, or would I rather scoop this up around 210? Those are the questions we have to ask. And it's really funny. Broadly, most retail traders are tripping over themselves to buy Apple at all-time highs or new highs. And then if it goes down to 208 or 210, don't want the stock anymore. It's the same way I talked about Bitcoin. Gosh, a few weeks back, I said, look, if you're looking at Bitcoin, don't wonder about what happens at 100,000. Gosh, don't engage it there. Wait for a pullback. And that's exactly what we've seen in Bitcoin. We take a look at the all-time high in Bitcoin. You can see it's 110.150. This is a Bitcoin futures contract. A 10% pullback and a 20% pullback. The 20% we've actually gotten to and exceeded. So this is the way I want to view longer-term opportunity, weekly time frames, 12 to 18-month time horizons. All right. And that's the way I'm looking at it. That's the way I'm going to look at it. And I'm going to continue to build that wish list of stocks that I would be absolutely fine with as long as they don't meet the criteria of being in a downtrend or meet the criteria of being in, say, the bearish hemisphere. And if you don't know what these things are, definitely join me for Charts and Coffee Monday through Friday. Check out the free video that I have at the Simpler Trading YouTube channel called the Sanity Check Setups. And then also you can come check out what we're doing where we build these portfolios throughout the year in the Sector Secrets Mastery. We've got, 19 positions that we've built since mid-2022. 19 alerts. 17 were triggered, right? 17 of these positions have been triggered, and I've actually closed 4 because they didn't meet the criteria, the follow-through that I wanted. So yes, on those longer-term holds, of course there's risk management. That's why I like applying a trader's mindset even to my longer-term holdings. So again, opportunity is here. Let's be patient about it, but let's build that list up. All right, so that's the topic for today. Hopefully that was helpful and gave you some bearings in an environment that feels like it's very much confusing chaos. Shut the TV off, pull up the charts. What we do and what we don't know is on the chart. Add some volatility, add some volume, add some macroeconomic understanding, like what the Federal Reserve is likely to do next this year. And you're going to find a lot more clarity than what most folks are going to want you to have, right? Jerry Springer versus having your own plan. Be good to each other, gang. I'll see you tomorrow for Charts and Coffee.